SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to the SUERF Baffi Bocconi high-level policy panel on financial markets, systemic risks in plumbing. Following the 2008 global financial crisis, financial markets have undergone substantial and wide-reaching reforms. Derivatives trading has been reshaped by mandated electronic trading and central clearing. These two core elements of the financial market infrastructure, that is, the plumbing, aim to mitigate the contagion risks seen in the Lehman episode and are associated with increasing trading activity. At the same time, the last few years have also witnessed stress events ranging from supposedly safe fixed income segments such as US Treasuries in March 2020, UK gilts in September 2022 to the US repo market in September 2019, in commodities in the first half of 2022, in equity, GameStopp episode in January 2021, and in CDS markets in March 2023. Two common factors of these stress episodes are a sharp and sudden decline in market liquidity and a jump in the margins called by major CCPs, which in turn led to increased liquidity risks for many market participants. These developments raise a number of questions about the resilience of market infrastructure and on the impact of regulation and the remaining risks in the plumbing of the global financial system. Now, before I continue, may I express my special thanks to Martin Scheicher from the ECB, who had the idea for this event, who initiated it, and who also chose the brilliant panel of speakers that we have today. We're very honored to have Imène Rahmouni-Rousseau, Director General of Market Operations at the ECB, as our moderator. Imène will guide us through the exchange of views among the top panelists and the Q&A with all participants. Professor Darrell Duffie from Stanford University will then offer an academic perspective, also drawing on two recent papers, which we also posted on the SUERF event website. Then Nicolas Vause, Senior Advisor at Capital Markets Division of the Bank of England, will offer a policymaker's perspective. Bart de Boer, Chief Commercial Officer at ABN AMRO Clearing, will bring a private sector view. And Froukelien Wendt, Director for Central Counterparties at ESMA, completes our picture with the supervisor's perspective. Without further ado, may I hand over to Imène.
Thank you very much, Ernest, for the kind introduction, and good afternoon and a warm welcome to the webinar, also from my side and from the ECB here in Frankfurt. So before giving the floor to our panelists, I'd like to introduce the discussion with a brief overview of the topics of today and also the significance of these issues in today's financial landscape. The topic of today is the plumbing of the global financial system. And plumbing refers in this context to the infrastructure for trading, clearing, and settling financial transactions. This infrastructure constitutes a critical underpinning of the activity of all market participants. And today we're going to focus mainly on two elements of this plumbing. So the first one is trading and intermediation. The bulk of the trading today in financial markets, and especially those that are relevant, for instance, for monetary policy, so basically bond markets, derivatives market, and also part of the money market, takes place in the darkness, so to speak, meaning that these are bilateral transactions that happen between market participants rather than transactions happening on centralized exchanges like in the equity markets. In these, what we call over-the-counter markets, you will hear the term OTC quite a lot, which is just the acronym for over-the-counter. Bank dealers act as core market makers, and these dealers provide liquidity for transactions with smaller firms, in part by using their own balance sheets for holding inventory or hedging. and the reforms that were carried out in the aftermath of the great financial crisis. So the reform that were spearheaded at the time by the G20 and the Financial Stability Board, these reforms have extensively changed the mechanisms and the costs of trading fixed income instruments. So that's the first brick, the first pillar we'll be looking at today, trading and intermediation. And then the second one is clearing. And central counterparties, what we call CCP, and general margining have significantly reduced counterparty credit risk when compared to the pre-Great Financial Crisis period. So the CCPs allow market participants to manage counterparty and liquidity risks efficiently and safely. Yeah. And basically, these CCPs have a unique structure in the form of a matchbook, meaning that they are not exposed to market risk, but they are exposed to counterparty risk. Yeah. And the CCP risk management tools, and I'm sure that we will have our panelists coming back on that, are first and foremost given by netting procedures, followed by margining practices, and as a last resort, the mutualization of any losses that would arise and are not covered by the own resources of the clearing members. So one advantage, and it's really the major advantage of CCPs vis-a-vis bilateral clearing, when clearing takes place between two market participants, is this multilateral character of the netting. And this would in turn mechanically reduce dealers' liquidity needs. And during the COVID crisis back in March 20, the margin calls of CCPs reached unprecedented levels. And this contributed to the famous dash for cash, raising liquidity for some market participants in the system. And this episode led in turn policymakers to reassess the impact of central clearing on system-wide liquidity risks and potential pro-cyclical effects. Yeah. So let me now very briefly introduce the four highly distinguished colleagues and speakers that are with us this afternoon. And it's a great pleasure to have you with us today. I'll start with Darrell Duffie. I think you all know him. He's a highly distinguished financial economist and currently the Adams Distinguished Professor of Management and Professor of Finance at the Graduate School of Business, and professor by courtesy at the Department of Economics at Stanford University. He has more than 100 research publications on an extremely wide range of topics in finance and has written plenty of groundbreaking papers on asset pricing, analysis of trading, and so on and so forth. And many of his papers are actually cornerstones that we use today for the development of key areas in financial economics. And Darrell, you've also been president of the American Finance Association. Nick is a senior advisor at the Bank of England. He has a long track record of highly relevant policy research on derivative markets, OTC trading, and other financial stability questions. And Nick, we share something in common, which is that we work, both of us, at the BIS. I think not very far away from each other in terms of period. And in the BIS, you were working on the economic costs and benefits of the post-crisis reforms of derivatives market. Yeah, and you graduated in economics from the universities of Cambridge and Warwick. So Jan Bart has been at ABN AMRO Clearing for almost 20 years as a member of the global management team. He oversees the sales and relationship management teams in the firm's 12 offices around the world. He's a board member of ABN AMRO Clearing Bank, and previously, Jan Bart, you held positions at ING and Fortis, and you graduated from Leiden University. And you're a board member of the Futures Industry Association. And Froukelien, you spent most of your career in central banking, like me, and international organizations, pretty much the same as me. So you are an independent member of the CCP Supervisory Committee and Director for CCPs at ESMA, the European Securities Markets Authority in Paris. And your areas of responsibility encompass the supervision of central counterparties, as well as related EU and global regulatory activities. And you play a key role in increasing supervisory convergence in the EU-wide supervision of CCPs. And before your time at ESMA, you worked at the IMF. So I'd now like, without further ado, to give the floor to our panelists to start the discussion. And I will start with Darrell. So Darrell, we've been facing, all of us, significant risks in the functioning of the fixed income market in the last years, yeah? And clearly this was evidenced in March 20 with the Dash for Cash episode. And you've been actually really closely involved in the US policy reform agenda on US Treasury markets and their structure. And we look forward to learning from you about both this unique episode of March 20 and also the reform process in the US Treasury market. You recently published a paper that provides a clear and thought-provoking evidence of the links between dealer balance sheet utilization and US Treasury market liquidity. And we're very interested to hear your views about the possible market structure for US Treasuries that would make this market more resilient. So Darrell, the floor is yours.
Thank you so much, Imène. Terrific to be here. Warm good afternoon to you all. It's still early morning here in California. I do want to talk about the US Treasury market, Imène. And going back to your opening remarks, there is an issue with the market structure of the US Treasury market. It's the world's most important market, and it is truly the deepest and most liquid market in the world, one upon which many investors rely as a safe haven. The issues, I'll get to the issues in March of 2020, but I want to drop back just for a moment to give a longer time span of what's happening in this market. Going back to the time at which Lehman failed, regulators properly addressed financial stability concerns at the largest banks and properly regulated them for capital and liquidity. However, that lowered their appetite for intermediating big markets like the US Treasury market. And since that time, the US Treasury market has grown enormously relative to the intermediation capacity of those largest banks. Just to give you an idea, since the fall of Lehman, the amount of treasuries per unit of dealer balance sheet space has gone up by a factor of almost 4. That is, there are 4 times as many treasuries now as in 2007 relative to $1 of balance sheet, meaning gross assets of the largest primary dealer, all of the primary dealers. And this trend is just not sustainable if you want to have a market structure that is capable of being resilient through a stress period, such as the financial crisis or March 2020. Dealer assets have gone down relative to GDP since then, more than 20%. At the same time, the quantity of US Treasury securities has now reached 100% of US GDP and is projected to grow to 150% of GDP by the Congressional Budget Office by the year 2050. This is just not sustainable, and I want to focus, as we are today, on market structure issues. So central clearing and trading, 2 of the key elements you mentioned, are both front and center in making this market resilient. When we think of a safe haven, like the US Treasury market, the world's dominant safe haven, we usually think of flight to quality. We usually think, in a crisis, people will buy US Treasuries because they're the safest security in the world. They will come out of risky assets and into Treasuries. That is true, but what's often neglected is that there is a second role of a safe haven, which is a source of liquidity in a crisis. What does that mean? It means that when investors are under stress and they need to reduce their risk, they sell treasuries because those are the easiest to sell. When foreign exchange reserve managers need to raise dollars to provide funding to their local banks or to support their foreign exchange reserves, foreign exchange prices, they need to sell US Treasuries. And in March of 2020, they sold an enormous quantity. I'm going to show a few slides just to illustrate the impact of these sales and the relationship between the key variables. Okay, you should see a chart which on the horizontal axis gives a sample period for some research that I completed on my sabbatical last year at the Federal Reserve Bank of New York with a number of colleagues there. And we spent the most of the year just working on the relationships that explain the lack of resilience in the US Treasury market in periods like the COVID shock of March of 2020. On the vertical axis is the z-scores of two key variables, a z-score meaning the number of standard deviations away from sample average. And the two time series shown are illiquidity in the US Treasury market in the thick black line and yield volatility in the US Treasury market, which is given by a thinner red line. I'm colorblind, but I think it's red. And you can see that's quite remarkable. They lie pretty much on top of each other, except if you look closely during March of 2020, the z-score for illiquidity went soaring way above yield volatility. So the relationship that normally holds, which is completely expected, that is when yields become more volatile, the market gets less liquid, that relationship broke down. And here it is in a scatter plot showing the relationship on the horizontal axis between yield volatility and US Treasury illiquidity on the vertical axis. So up here is bad, means bad liquidity. And you can see that that relationship, which has an 84% R squared, it's extremely regular, has some very important outliers. And that's not noise. Those little red blocks for March of 2020 show, again, that US Treasury illiquidity was far worse than predicted by volatility during that period. So what exactly happened? This is a chart showing how much of dealer balance sheet space was being used up to intermediate the US bond markets, all of the bond markets, agency, MBS, corporates, and treasuries. And you can see that in March of 2020, illiquidity, balance sheet utilization was at record high levels. Whether you're looking at gross positions, net positions, dealer to customer volume, gross or net, and all of these are risk adjusted. So there was something special going on in March of 2020, and that was the second safe haven function that I mentioned. Investors all over the world flooded the dealers with demands for liquidity, and the dealers were simply unable to intermediate the market during that stress period. This is the last chart that I'm going to show, Imène. On the vertical axis is US Treasury illiquidity, but now I'm taking out the component that's explained by volatility and showing only the residual. You saw this slide, and in fact, you discussed it in Zurich, in Basel early this year, just as we were completing this research. And you can see that normally illiquidity doesn't vary as you move capacity utilization of dealers on the left-hand side of this chart. It's very insensitive on the left-hand side, but when the capacity utilization of dealers moves to the right, meaning higher capacity utilization, you get far more illiquidity in the US Treasury market, above and beyond that explained by volatility. So what must be done? I'm going to stop showing slides, and I'm just going to try to finish by saying what must be done about market structure to improve the situation. Well, central clearing, one of our two main themes, will use those dealer balance sheets more efficiently. It will make it possible to do more intermediation with less balance sheet space through the effect of netting purchases against sales at the central counterparty. Not to mention that it's much safer to clear the market centrally. But also important, if you have central clearing, then the barrier to providing all-to-all trade as an additional source of trading intermediation will be much lower. That is, it'll be easier for investors to trade directly with each other rather than on a dealer balance sheet. Today, every investor trade must be intermediated by a dealer. Another possibility, and none of these will necessarily cure the problem, would be to allow transactions prices to be revealed to the market. Right now, the US government is collecting all of the transactions prices, but they are not being reported to the public, and it's difficult for investors to get a good match for their trades if they don't know what the going price is. Finally, when all else fails, central banks need to be ready as a last resort to provide liquidity to the market. They can do that first as a lender of last resort, providing financing to those who need cash but don't need to sell their securities. But when finally that doesn't work, central banks need, in my view, to be ready to purchase government securities in order to provide more intermediation space for dealers. That is, take some of these government securities off their balance sheet so that they can provide further intermediation to their customers. And I know at the European Central Bank, you have a transmission protection instrument, or TPI, that allows just that. And other central banks are developing approaches that would allow them to step in, just as the Bank of England stepped in the gilt market in last fall. So, Imène, I'm going to pass the baton back to you and your team. Thank you again for the opportunity.
Thank you again, Darrell. That was terrific. So every time I listened to you in Basel, and I looked at your Jackson Hole presentation, and now this time, it seems clear to me that you have really went to basically a very important aspect of how the bond markets function, with this capacity to not only measure dealer capacity, but really to articulate it, to link it to liquidity in the market in a very neat way. Yeah. And I also appreciate the link to the central bank toolkit and what can be done about this. And I'm sure that our discussion later on will touch on this again. So now let's transition from the US Treasury market to another big market that is at the heart of the functioning of the financial system. And these are derivatives markets. And Nick, of course, I turn to you. You've been analyzing, these derivatives markets for a very long time, and it would be great to understand how could the market structure for this market be reduced. So derivatives, but also, we're just discussing bond markets, be reformed to reduce reliance on dealer balance sheet. And you've been doing work this time on the gilt market. So very eager to learn from you from that side of things. Nick, the floor is yours.
Great, thank you. And I see some slides that I have been shared already, which is super. So hello everyone, and thank you to the organisers for including me on such a distinguished panel today. Before I begin, I should just quickly note that the remarks that I'll make today will be my own views and not those of the Bank of England. So if we can skip to the next slide, please. So Martin asked me to touch on 3 topics today, and I thought I might cover them by going from the more specific to the more general. So I'll start on central clearing and show some specific results for UK government bond markets on the degree to which clearing could reduce exposures on dealer balance sheets. So exactly what Darrell was just saying about the netting benefits, but I'll try and show some quantitative results for the UK market, and it will draw on a working paper that I've recently published with a few Bank of England colleagues. Then second, I'll offer some broader thoughts alongside clearing on ways to reduce the current reliance on dealer balance sheets for intermediation of government bond markets. Actually, quite an overlap with some of the ideas Darrell was just mentioning, but And then finally, I'll offer some even wider thoughts on systemic risks in OTC markets and how they might be mitigated, and that's where I'll turn to the derivatives market. So I think that gives me about 3 minutes on each, so we better go to the next slide, please. And yeah, in terms of the paper I just mentioned, and there's a reference to it at the bottom of the slide, we started in terms of the methodology by gathering some regulatory data on UK dealers' trades in gilt and gilt repurchase agreements in the first quarter of 2020, which of course included the COVID-induced dash for cash in March. And for those various trades, the dealers had different counterparties. We simply switched all of those counterparties for a single CCP and calculated the reduction in dealers' exposures due to sales and purchases in one case, or repos and reverse repos in another case, becoming nettable as a result of having a common counterparty. And the exposures were measured as in the Basel III leverage ratio, which some dealers have cited as a constraint on their intermediation capacity at the time. So in terms of the results, we found some sizable percentage reductions in exposures. For gilt trades, it was as high as 80%. However, there's a methodological change to the computation of the leverage ratio exposures introduced at the start of 2023. That means all dealer banks can now net cash payables and receivables associated with security sales and purchases, regardless of their adopted accounting standard. Whereas back in the first quarter of 2020, some could and some couldn't. And the 80% exposure reduction is an average for those that couldn't, and so would have benefited from greater netting under central clearing. But now all dealer banks can net across counterparties under Basel III. So we don't think there'd be any incremental benefits of broadening central clearing for cash securities, at least in terms of leverage ratio exposures. But for repo trades, the benefits remain. And here we found a 40% reduction in exposures on average. This is a lower figure than we had for cash gilts, partly because repos can have a range of maturity dates, and the maturity of a repo and reverse repo have to match, as well as the counterparty, for exposures to be netted. So we ran an additional experiment in which, as well as switching counterparties, as well as the counterparty switch that we made, we standardized maturity dates to a common day of the week. So specifically, with the exception of overnight repos, we switched maturity dates to the nearest Wednesday, and that delivered a 55% reduction in exposures on average. So we think that broader central clearing of repos in particular could boost dealers' intermediation capacity. Roughly speaking, it would mean that when trading surges, like during the dash for cash, dealers could accommodate twice as many trades for the same increase in exposures and capital requirements. So if I can go to the next slide and broaden out. So this is on ideas to reduce the reliance on dealers' balance sheets. And first on the slide, I have central clearing, which we've just spoken about. I think that could be extended by force through mandates or incentivized by making the bilateral market more expensive. For instance, minimum haircuts could be imposed on government bond repo markets. They're still often zero in US Treasury and gilt markets, for example, despite the price volatility of the securities definitely not being zero. Second, I've got all-to-all trading, which could help, I think, by increasing matching efficiency. So at present, government bond trading is often quite relationship-based, but in such a market structure, a particular dealer could struggle to sell on a bond that it had just purchased, even though there might be a willing buyer in the market, if that buyer wasn't a regular client of the dealer. On an all-to-all platform, however, they could easily meet, and that could help dealers to flip bonds from their inventories and hence intermediate bond markets with a smaller inventory on average. And moreover, as Darrell said, two non-dealers can also trade directly on an all-to-all platform, and those trades obviously wouldn't need any dealer balance sheet capacity. Then third, and sorry, Darrell had it as well, I think close to real-time post-trade transparency, as made available through a consolidated tape, for example, could give market participants more confidence to trade by giving them a stronger sense of the fair price and liquidity of the market. And that could support all-to-all trading, or even just improve the liquidity of the bilateral market, which could still help dealers to flip bonds from their inventories relatively quickly, and therefore operate with smaller inventories. And then fourth, central banks could step in and trade securities when dealers were unable to. This option, I think, has understandably been placed into the debate as a last resort tool for the most extreme stresses, and where other options, including central bank lending tools, have been considered or exhausted. Also, I think its terms should be set to discourage the moral hazard of additional risk-taking, with regulators potentially checking that would-be users had indeed taken sufficient self-insurance against risks. And finally, more jurisdictions might perhaps consider having a counter-cyclical buffer, not only on the risk-weighted capital ratio, but also on the leverage ratio. We have both in the UK, and that means we could raise the leverage ratio in good times if we thought dealer banks were not keeping sufficient balance sheet flex for a dash for cash kind of risk, and then cut it to give dealers more capacity if that risk did indeed materialize. So conscious of the time, could I just go to the last slide, and I'll be as quick as I can. Yeah, so lastly, I wanted to turn to systemic risk in OTC markets more broadly. There's no doubt lots that could be said here, but I just want to highlight one thing that strikes me as a key issue. And it's, while more widespread central clearing of OTC derivatives since the global financial crisis has delivered a first-order benefit, I think, in greatly reducing counterparty credit risk in the market, it's come with a second-order cost of greater liquidity risk for clearing participants who seem to have been caught by surprise by large margin calls a number of times in recent years. And I think there are a couple of things that might help in this regard. So one is that we could perhaps look again at dampening the reactivity, or sometimes called pro-cyclicality, of CCP initial margin models. For example, could a similar approach be taken as in bilateral markets, where the ISDA standard initial margin model tends to produce admittedly higher but less variable margins? Or could CCPs be set targets for reactivity, like the margins should react, say, like 25% less than volatility in the historic data, and then given that target, they could design their models accordingly. And the other point is to help market participants better prepare for margin calls. This could be done, for example, by providing them with information on what would be a 1 in 100 or 1 in 1,000 margin call on their current portfolios. Or we could require them to run their own liquidity stress tests and set out to their investors how they've done that and how they've set their liquidity buffers accordingly. And I'll stop there. Thank you very much.
Thanks very much, Nick. And that was a fascinating, yeah, as you said, quantitative exercise on the gilt market, and then broadening the topic. So now that we had, mention of central clearing many times, let me pass to Jan Bart. Yeah, I mean, you're a major practitioner, major market participant in clearing, and you have really a front row seat to observe the risk management of many major CCPs that ADRA AMRO is active on. So can you describe for us the observations you have and the policy lessons that you could draw from that? Yeah. And in particular, I'm interested into, the window you might have on non-bank participants to derivatives market, and in particular, principal trading firms, PTFs in particular. If you can elaborate a little bit on the business model and risks of this new type of dealers. The floor is yours.
Okay, fantastic. Well, thanks very much for your time, for all the participants this afternoon. We are clearly in extreme strange times, also from a policy making, or maybe thinking about policy making around clearing and trading. I think the two earlier presenters commented on that. And if I kind of go back to my own experience, I think we could say that after 2008, the world became a bit boring from a market volatility perspective. I think the people who've been in the market for a long time kind of realized that we had, apart from Brexit, the Trump election, the flash crash, we didn't have too many events putting strain on the system. Yet what we have seen in the past 3 years, and it's the pandemic, it's war, but also other events, I think probably drive us to re-evaluate a bit what has been going on and how we should react on that. Very quickly, we are a global firm. We only service professional clients. The majority of our clients are what you would call non-bank liquidity providers. We do that in every part of the world. We probably have a market share of 10% in cleared equities, futures probably around 20%, and options in certain markets even higher, partly because our clients are quite often the other side of a trade, because we're talking here about the listed futures, options, and equity markets. Some of our clients are also more corporates using the markets to lay off physical risks. That's our experience with the LME and our experience with the oil and gas. That's what I don't know what is a fantastic word to use it, but it was a kind of it was not an easy time. And we have got a prime business which looks after interest rate swap clearing for asset managers, pension funds, and insurance companies. I would like to focus on three parties which are surrounding the CCP. And the first one is probably on the marketplace, because we feel that the role of the marketplace could get a bit more attention in keeping the system safe, or keeping central counterparties safe, and therefore also their clearing members. What we have seen, being it the Aramco attack, the flash crash, the Texas polar freeze, quite often the central counterparty sits there to accept the risks, whereas maybe the marketplace, the exchange or the MTF, could have done their work a bit more diligent, or could have stopped it. I'm talking about having proper volatility controls. That probably would have helped the LME. But do not forget, when Texas, the power contract spiked literally from, say, $20 to $10,000 just before the weekend, when wind turbines were frozen over in Texas, that had a massive impact on the CCP and their clearing members. Markets not having clear trade out or erroneous trade rules can create issues. We have seen that in Korea, probably 15 years ago, where a clear fat finger still brought a trading member down, and therefore impacted all the clearing members, and they had to dip into they had to pay into the default fund. I'm talking about pre-trade risk controls. We find them 50C3 or in MiFID, but I think the onus on marketplaces to prevent excessive ordering, clear wrong prices, fat fingers, are definitely there to protect the system. And Knight lost 400 million, and that would have had impacted DTCC if Knight would have been taken over. We still see markets which are open while the central counterparty is closed. Bit odd. We question the legal agreements between central counterparties and exchanges. We feel that there is a bit of a lack there from exchanges not taking a lot of ownership of the data and the timing, which means that the central counterparty could be in the dark for a while. Or if the clearing member wants a trading member to be switched off, how quickly will this happen to also the exchange level? Not all markets have kill switches. We see it in product selection, which gives, given the fact that the skin in the game only sits at the CCP, might give wrong incentives. And by the way, we see this both in silo CCPs and horizontal CCPs. We believe that therefore skin in the game for a market operator could not be a bad idea. We could feel that the C factor could be used to introduce more of these factors, and a competition between marketplaces would help to create positive selection of market participants. Clearing members, we are the first and last line of defense. We kind of underwrite the risk of the client's portfolio. I think that's all well known. We are for more than 50 billion on the hook collectively with our contributions into the default fund. So we have a lot of reasons to keep central counterparties clear. We feel that on transparency and adequacy of margin, margin floors, work could be done. The jumps we saw in Q1 2020, where the benchmark contracts doubled from an IM perspective, or what we saw in the power and gas market. And granted, I think that was a war situation. Probably our system was not designed for war, but seeing increases of 10 times of the IM does have a massive impact on the market, the market by itself, and you have to ask yourself if there's still a fair and orderly market at that moment. And last, operational excellence, not only from central counterparties and exchanges, but also I think it's a well-known fact that we like targets to be open as long as markets are open, and if we get after hours margin calls from central counterparties, we should be allowed to pay them in the home currency instead of, for instance, US dollars. Last, something to say about the role of the non-bank liquidity providers. I think in our contribution, we really focus on the EU markets and ETD products. We see that a significant part of the liquidity on those markets comes from these non-bank liquidity providers. And a large part also being clients of our firm. We have seen their rise over the years, coming from the floor, benefiting from electronification and benefiting from central counterparties. The fact that you can trade anonymous, it's not your logo, but it's your price which decide if you get a trade, and people can trade and trust that the trade will settle. And in 2008 already, we saw that, for instance, in the cleanup of the Lehman books, in the US, part of that book went to a prop trading firm. In Europe, part of that book went to a prop trading firm. So for markets and central counterparties, that liquidity is really necessary, not only in the good times, but also in the bad times. And unfortunately, and again, I will concentrate on the EU now, even though I know that, say, the FIA PTG community in the US has got strong opinions about the SEC proposals on liberating, I don't want to call it liberating, that's the wrong word, apologies, making that market more dynamic. Even also in Europe, we see that Euro MTS is not open to all participants, which does not help liquidity. And with IFR, IFD, regulators or policymakers have created harmonized rules also from a prudential perspective, which is great and also makes the life of a clearing firm easier. Yet there might be some unintended consequences which we see more often, where we see certain firms leaving certain parts of the market. And if we talk about IFR, IFD, I think we should think about if the medicine was there for non-bank liquidity providers in traditional financial markets to use prudential rules, should we not also think then about the power and gas markets? And this was really when I was talking to Martin, he said, yes, but non-financial, or say non-bank liquidity providers, they're only there in the good days, but in the bad days. So when looking at our data, going back from 2018, looking at, say, a what we would call high stress moments. We're talking about the start of COVID, the invasion in Ukraine, the LME. We use as a proxy there the Euro Stoxx 50 volatility as a signal, and also we looked at how many transactions we saw in those markets, and then our data shows that. And I think you can look at it's a crowded sheet, but if you look at, say, the green and the red little, must be a word for this, dots, the ratio of increase in the Euro Stoxx 50 contract compared to the ratio of the increase of, say, 10 of our larger proprietary trading firms quoting and trading in those markets, shows that, in fact, where the market increases, we also see our client base increasing in activity. By the way, we see the same data if we would look at the amount of liquidity or leverage we extend to them, or if we look at our CCP, IM, and VM numbers. But I think this shows that, at least in the European equity futures and option markets, non-bank liquidity providers are key to keep markets liquid, also on the very high volatility days. And that is 11 minutes, so I probably should pause here. Thank you very much.
Thanks very much, Jan Bart. Really interesting, and also your different figures that you showed here in episodes. So now I turn to Froukelien. You contributed to launch the ESMA's CCP Supervisory Committee, which is playing now a crucial role for CCPs and has the overall objective to enhance supervisory convergence and ensure a resilient CCP landscape. And among the many tasks of this committee, I understand that there's a coordination of the regular CCP stress testing exercise. So against this background of looking from very close to CCPs from this capacity, what are, in your view, the key risks in central clearing, and what should be the supervisory and the regulatory response to these risks? And I can't resist to ask, how does Brexit also affect these risks going forward? Thank you, and the floor is yours, Froukelien.
Thank you very much, Imène, and let me first start by thanking you for the opportunity to provide here the perspective of a supervisor and regulator, and then specifically for the EU. Indeed, there has been a time when CCPs were not very known, which fully changed since the global financial crisis and the response of the G20, as we have already heard several times. And Imène, you very nicely explained the benefits of a CCP, which indeed are to increase transparency, there's central risk management, low collateral requirements through multilateral netting. I would like to say that these benefits hold as long as the CCP itself is safe, well governed, has good risk management. Because if that's not the case, a CCP can be a source of systemic risk, with losses spreading through the system, through all the interconnected parties, clearing members, clients, banks, other FMIs. So that is why you also saw, since the global financial crisis and G20 mandate in 2009, that the international regulatory community has stepped significantly up the international standards, which were in the end the principles for financial market infrastructures issued in 2012, which then have been translated in national legislation, and in the EU that has been EMIR. And the CCP Supervisory Committee is a body in the EU, I would say a central body, has been introduced in 2020 following the EMIR 2.2 revision. Before that, or let's say in 2020, it became in force. And that supervisory body consists of all relevant EU entities. So 12 NCAs that govern CCP or that supervise CCPs, and central banks of issue where relevant, and there are three independent members, of which one is a chair, to make sure that really the EU interests are taken into account. Now, indeed, risk identification in relation to CCPs, risk mitigation are at the core of our mandate. And stepping back to the specific risks of central clearing, I think you can identify from a macroprudential perspective two types. One is the structural risk to CCPs, what I just mentioned. The CCP itself should be safe, a well-governed, good risk management, because otherwise, if it fails, it spreads losses to the system. So that's one type of risk related, one type of systemic risk. The other type has to do with the cyclical, the pro-cyclical nature of the margin calls. And for those less familiar, CCPs typically have a range of parameters that determine the size of the margin. The price level, volatility are among them, so you can see that if there were changes, as we saw during COVID, during the energy crisis last year, with strong increases in prices and a high increase in volatility, then in a mechanical way, the margin calls of CCPs increase, both typically what we see in size and in frequency. So if you look at these two types, structural versus cyclical systemic risk, I think we can conclude based on the recent events that that first type of risk was well addressed. So CCPs managed to continue their operations, to cover their exposures, and all the critical operations could continue. But the cyclical type of risk is another story, because we saw strong pressure on clearing members, on clients in the commodities market, especially the non-financial participants. So the ecosystem was under stress. So if you ask what are the risks that we currently see in relation to central clearing, I would say that thanks to the PFMI, to how things have been implemented in national regulation, that the CCPs are itself have proven to be resilient. But the issue of the procyclical nature of the margin calls, and Bart mentioned that very nicely, is something that we need to address. And I must say that the PFMI and also AMIR do include requirements to reduce the procyclical nature of margin. And let's be fair, there will always be a level of procyclicality by the way the margin models are designed. But you can build in several tools to reduce that impact, to temper it in a way. And in the EU, we have possibilities for CCPs to implement a floor in their margin models, a buffer, or they can also calibrate margins based on a certain percentage of stress margin. So we at the CCP Supervisory Committee are very actively monitoring what has been going on. We have developed regulatory technical standards, which were published in July after intense consultation and research. We have also been participating at the international standard setting level to see what we can do in a global context. And as you may know, we have been developing analytics, but also are developing future guidance, and a consultation paper on that will be issued later in the year. This, on the one hand, addresses APC metrics, but also transparency, that was also mentioned by speakers before. And transparency is especially, I think, needed for market participants to better anticipate what is coming, what margin calls can they expect, and then at the different levels of clearing members and clients, and also the proposal for AMIR 3, which the Commission issued in December last year, does contain increased requirements for that. It's a bit early to say whether these indeed will be implemented, because as you may know, the European Parliament has issued its perspective, the European Council, and based on the trilogue that is planned for the coming months, we will see what the outcome is. But you see that on the CCP Supervisory Committee side, together with the NCAs and the central banks of issue, we try to monitor that, try to, in our supervisory capacity, try to address that through model validations that we also can do under AMIR. Supervisory convergence is a possible route, and of course, regulatory book. Let me see how many minutes I still have. Maybe one last thing on the point that you raised about Brexit. So indeed, we've seen stress in the commodities market in the as part of COVID. There were other cases, and procyclicality is a risk that we need to address, but it should not prevent us from also looking more structurally at the EU clearing ecosystem, where there is, and that's not a surprise because we have been talking about it for years, the general feeling at the level of the European Commission and generally also ESMA and other authorities, that there's an over-reliance on UK CCPs. So 2 years ago, we have in depth analyzed the dependence of the financial system, particularly on LCH Limited and ICU in the UK. We have looked at factors that determine systemic importance and concluded that for some segments, for example, swap clear of LCH Limited, they are of substantial systemic importance because of size, interconnections, but also impact on monetary policy. So we believe that from all the options that are considered to address this, and we are very aware of the need to keep on well-functioning, efficient markets, access of EU markets to the liquidity pool in London, taking everything into account. The active account requirement is the most balanced approach. It would ensure that a proportion of critical clearing services takes place in the EU, which reduces the dependence, but at the same time, EU markets remain to have that access. And that then brings, and that's my last point, a question about, is the CCP supervisory structure in the EU with the CCP Supervisory Committee where it should be? And there's active debate at a political level as well, whether maybe we should strengthen that more to address the cross-border risks that also relate to EU. So with that, thank you very much, and happy to look forward to the.
Thank you very much. That was a great launch from each of you. So we already have questions appearing on the chat, and before taking them, I just wanted to give the opportunity to every panelist in the same order to come back on what the others have said. If this has inspired some additional points or remarks you'd like to make, and I'll start with Darrell.
Thanks, Imène. Terrific remarks from my co-panelists. I was going to ask Nicolas, you mentioned that there's no regulatory capital benefit associated with the central clearing of government securities because the settlement of those trades doesn't require any capital anyway. 2 points on that I'd like to get your views on. One is, should there not be a regulatory capital, at least some, associated with the counterparty risk on a treasury securities trade? That's why we have central clearing in the first place, to reduce counterparty risk. And the fact that it's centrally cleared does not eliminate the counterparty risk. Secondly, the distinction between repo and cash kind of escapes me. The counterparty risk associated with settling a repo closing leg is identical economically, legally, and in every sense with that of a cash securities trade. So why should one of those have no regulatory capital requirement and the other require the full leverage ratio requirement? Shouldn't we modify at least somewhat the dramatic distinction between those two capital treatments? There is real economic risk, and there was more than $1 trillion of settlements in one day in the US Treasury market in March of 2020. And I talked to dealers who said that was enough. They didn't want to do anymore because it was too much risk.
Thanks, Darrell. So Nook, the floor is yours.
Thanks. Yeah, so I'm not denying there's counterparty risk in unsettled US Treasury or other government bond trades. It was a point purely about the leverage ratio, capital requirement, where at the beginning of this year, the Basel III leverage ratio was tweaked so that like so-called regular way sales and purchases, basically like normal sales and purchases of securities could be netted for the purpose of the leverage ratio, regardless of the counterparty, and that was to equalize the treatment of different dealers with different accounting standards. I forget which way around it was, but possibly US GAAP dealers were benefiting, and IFRS dealers with IFRS accounting standards were not. So the leverage ratio was harmonized in a way that netting was allowed regardless of counterparty, and that gave the same benefits as for central clearing, but it's purely a point about leverage ratio capital and not about counterparty risk, which might well need to be capitalized under the risk-weighted ratio, for example. When I take the point about equivalence of the leg that's still to be settled at the end of a repo, yeah, I think at the moment that would be inconsistent the way it's treated in the leverage ratio. So perhaps that needs some thought. Could I say a bit about some of the other presentations as well? So I enjoyed all the presentations, and on Jan Bart's, agreed with the point about skin in the game for exchanges. Thought that's a good point, and just wondered on competition between exchanges, which was something you advocated, whether you thought there could possibly be a race to the bottom with margin standards. I think there's a recent ECB working paper that's just come out in one of the top finance journals showing that two clearers in the same market, when one reduces its margin requirements, the other follows, and vice versa. And then enjoyed Frank Klein's presentation as well. I thought that was a nice distinction between structural risks and dynamic risks or pro-cyclical risks. Thought maybe it was even more impressive that CCPs performed well during March 2020 because everyone was working at home and those operational processes still worked well. On the dynamic risks or the pro-cyclical ones, I wondered if you had any thoughts on the pro-cyclicality tools that are in place at the moment. I think you mentioned there are 3 options in Europe, and I think I saw a survey that said the most popular choice is the floor tool, which just has puts a floor on margins. I wondered how much that helps, because quite often margins are a little bit above the floor, and then in a stress they really jump up. And if you're above a floor that's not binding, whether they help with that particular risk. Thanks.
Shall I go first?
Yes, please.
Yes, I shall first answer and then also ask the question. So on the question on the competition, it's true. I think we have seen in the oil complex, for instance, that this mirroring it happens. But I'm more trying to think from having a single engine where we collate all the risk in one way or another seems, even though it might be very efficient, creates a single point of failure. Whereas if you would have a multiple of clear CCPs and exchanges capable of creating price formation and netting and therefore risk reducing, it helps, even from a cyber perspective. Nowadays, we have created these single point of failures and some of these large silos. As much as I applaud them for being very efficient and creating great services for their members and their shareholders, if they go down, the market is gone. And you might ask yourself, hence, if there was competition, so we like therefore interoperability, because at least a certain part of the market will remain afloat. We like the fact that, say, oil therefore trades both in the CME complex and the ICE complex. So if one goes down, the other is still there. I think that's kind of how we view this. And today, even if you would want to vote with your feet from a risk perspective, because mind you, it's not that all the users all the time want the lowest price or the less margin. Funnily enough, the FIA has been advocating now for probably 3 years for higher margins, because we rather see that the polluter pays, and the world that everyone was saying the lower the better, I think is a bit gone. So at least that's my answer. So I would go then, say, probably to the first speaker. So a question to Darrell and then a question to Froukelien. I will do Froukelien first. And we have to say obviously something about the dialogue on active accounts and not active accounts. Again, I go to my starting point. I rather would go for a more risk-driven perspective, where we could create better capital relief for a central counterparty, which is better than a central counterparty which is not as good. So go back to the C factor and try to use that to steer the behavior of the market. Anyhow, if it's not that, and maybe the question is, was that ever considered? Then maybe the other question is more, can we at least ensure that then the clearing members are not part of this, because the clearing members do not decide where a trade goes, it's their clients. And then maybe going back to Darrell and his great presentation on liquidity in the US Treasury market. There are high frequency traders or proprietary trading members active in that market. In your study, do you come across them and do they create a bit of a benefit, or is it kind of, does it move the needle?
Yeah, that's a great question. So Froukelien, I'll let you answer the question, also provide your thoughts, and then we'll turn to Darrell and then we'll open up to questions.
Thank you. So on the question about the APC tools from Nick, indeed, there's a difference in popularity between the different tools. The thought behind providing a kind of a menu to choose from is because there's no CCP similar as another. There's no one size fits all. CCPs differ in terms of markets they clear, of type of clearing members, the liquidity of the market. So the idea behind 3 different tools is that it allows CCPs based on thorough consideration to choose what is best for their market. And I fully agree with the point you make on to what extent does it help. And maybe it's because I'm from the Netherlands, but I always think about APC measures as dikes. So they are dikes that help prevent to let the water in. And in that sense, you could see APC tools in more or less normal storms to be effective. Now, I think what we saw were more of the level of tsunamis last year in the commodities markets, for example. Then APC tools are not sufficient. The water will flow over the dikes. And nevertheless, there is always a benefit in tempering the size of the module. So that's I hope an answer to the very interesting point you raised. And then to the point of Jan Bart, this discussion is going on for a long time, and many different tools have been discussed. Pros and cons have been evaluated, and I think it's very important to have to meet the different objectives of policymakers, which on the one hand is risk reduction, and that is also in this case a reduction of the dependency of the EU on the CCPs, but at the same time you want the markets to be efficient, to not come with too many additional costs, that there's a level playing field. And based on all these discussions and the different considerations, in the end, the active account is the one that is proposed in the Commission's proposal of December. And yes, to who should it apply? Should there be a qualitative threshold or quantitative? These are all things to consider for the politics, and we will see the outcome. We will see the discussion in the upcoming trial. So, if I may ask a question, then my first question is to both Nick and Darrell, and I am sorry for one of the people in the chat because I had exactly the same question that you put on the liquidity needs, because the clearing of securities, in particular bonds, comes in the case of a default of one of the clearing members with a huge pressure on the CCP to step in for the defaulter and to finish the transaction and come up with the needed liquidity. And in the case of bonds, the transaction value is typically much higher than derivatives. In other words, clearing bonds does a high demands a lot from CCPs in terms of liquidity management. So if you could elaborate a bit on that, that would be very interesting from a risk perspective. And then my question for Jan Bart is, what do you think? Because the impact of trading on clearing is well taken, and in fact I agree, but I think also that there are measures already in place, such as circuit breakers. So if you have any views on that, that would be much appreciated.
Thanks, Froukelien. And I think you made actually my job much easier by bundling the panelists and the audience questions. Yeah. And before passing the floor to Darrell and Nick to answer on this very important question of liquidity and CCPs, I mean, I think also from the central bank perspective, and it is mentioned in the question actually from the audience, is that we do have a different landscape as regards CCP access to the central bank. Yeah. So just to give the example of the euro area, and I'm sure, Darrell, you will come back on the US, but in the euro area, some CCPs have access to the central bank because they are credit institutions. Yeah, so they are regulated like banks, and because they are regulated like banks, they have exactly the same access than banks to the central bank. But the CCPs that are not credit institutions would then not have the same access to the central bank. But I'm curious to hear your thoughts on how it plays out. Darrell, please.
Yeah, in the United States, the situation is somewhat different. Under the Dodd-Frank Act, the Fed does have the ability to interface directly with a CCP, for example, to provide liquidity in an extreme event. However, the Fed is not currently a member of the only major CCP in the US Treasury market, which is the Fixed Income Clearing Corporation. So it can provide liquidity, but it has not acted as though it would be willing to do that. That said, I think it would. I mean, of course, in a very significant event, the Fed would do what it can. It would be better, and as the questioner in the chat asks, it would be better, in my view, if the Fed were to become a clearing member, a non-loss sharing clearing member, because under its central banking function, it should not be bearing losses, but that's understandable given that the Fed is free of credit risk. It should be a non-loss sharing member so that it can provide liquidity in extreme events, and also so that it can provide liquidity, perhaps even not in extreme events, through its standing repo facility to a broader set of counterparties. If it were to do that, it could face a broad set of counterparties in terms of repo financing, while still only facing the central counterparty as a counterparty to credit risk. So that's a natural for me, although it's a big step for the Fed to say that it will do this. I'd briefly react to Jan Bart's question about high-frequency trading firms, if that's okay, Imène, can I mention? Yeah, these principal trading firms like Jump, DRW, Citadel, and so on, there's good news and bad news. They do intermediate a significant amount of on-the-run trading in the limit order book market at BrokerTec. And so they do lower the costs of trading on the runs among the dealers and provide liquidity. That's the good news. It's often said that they disappear in a crisis. That's not true, actually. They provide roughly the same amount of intermediation in a crisis as in normal times, but it looks like they're dropping away because their market share drops relative to the primary dealers, but they continue to do about the same amount. So net, they're positive. Now the bad news, their trades are not centrally cleared. All of the other trades at this limit order book called BrokerTec are centrally cleared because primary dealers are required to centrally clear. So now you have a buildup of systemic risk by which the trade platform BrokerTec itself is acting as a de facto central counterparty, committing to settle trades with these high frequency firms, but is not regulated as a central counterparty and has few of the safeguards of a central counterparty. That is a systemic flaw. The Securities and Exchange Commission is trying to correct that, but there's some pushback, and I hope that pushback does not succeed.
Thanks.
Thanks. Nick, you want to follow up us on that point?
On the liquidity point, I guess the only thing that I might add is thinking about what's the alternative. So it would be to have the US Treasury or other government bonds not centrally cleared, and then you wouldn't benefit from the netting, and the liquidity payments and liquidity risk in the system as a whole would be bigger. If they're at the CCP, they'd be netted down. I guess the downside is they'd be at a super systemic institution, but that's where having, depending on which jurisdiction you're in, potential liquidity support from the central bank could help.
Thanks very much. So now, among the questions there's one around technology that I really like. To what extent, Alistair, to what extent can digital technologies support greater balance sheet capacity? So if you were to shift from the current T+2 in settlement to near time or near real time settlement, and maybe we can add to the question, are things like tokenization, for example, potentially also having an impact on balance sheet capacity, or is it only, a different way of doing things? It's more efficient potentially, it reduces lead times and interoperability is better and so on, but it doesn't impact this crucial point of dealer capacity. I'd like to have, your thoughts and clarifying thoughts on this. So who would like to start on this, technology and dealer capacity?
I can at least share some thoughts. The majority of the liquidity sits in the derivatives markets. So even if the equity markets go to T+1, I mean, yes, it would have, they got saved, but it would have helped Robin Hood during the meme stock disaster. But the amount of liquidity tied up there is probably 1/100th of what sits in the derivatives market. So I truly do not really see that we should go to T+1 from a liquidity perspective, or T+0. And if we talk about, say, because quicker settlements, we're talking about equities derivatives settle on the second, and then they stay there for 30 years or 10 or a day. So that market is not going to be benefiting from new technology. Again, if we would go towards, say, risk management or liquidity. It would help if Target was open 24 hours a day. Because in all fairness, we can.
How would it help? I'm curious about that. 24 hours a day.
Well, because we want to risk manage in real time, and therefore we also want to be able to call for margin and pay up whenever it's needed and whenever prices change. And therefore we rely either on the Fed, who's open more often or longer, but then they've got holidays. So I can only say, if we want to give the public what they want, that's to trade 24/7 also in the weekends. That means that especially the payment colleagues from central banks cannot have holidays nor weekends anymore.
No, that's an interesting point. And I don't know how it links to the other point that is made on the chat on central bank digital currencies. I mean, in my view, it's really slightly different CBDCs. Yeah. Also because there are different flavors of CBDC, and at least in the euro area, what is being looked at is more a retail one. But I mean, yeah, we can see that there's also a link, and I agree with payment systems more generally, the payment landscape. Our other panelists wanted to react on this technology point and dealer capacity.
Could I react briefly? So there's good news and bad news again. So the good news is you lower counterparty risk and you get 24/7, 365 settlement. There's no need for a systemically important central counterparty if you have tokenized settlement. So this all sounds great. However, there's a downside, which is you can't conduct a trade of cash for treasuries or cash for anything until you have the buyer has all the cash ready to settle, and the seller has all the securities ready to settle, which means a huge expansion of dealer balance sheets and probably central bank balance sheets to make sure that there's enough cash, meaning central bank deposits, in advance of the trade. You can't net if you do this. It has to be all gross real time, and that's very expensive. I ran some calculations that it would roughly double if you don't do any mitigation, double the size of central bank balance sheets, which is a horrifying concept in the United States. However, there are ways around this, but today is not the day to do that.
Thanks a lot. I completely get that now. Yeah, indeed. Maybe before we close, we can take one more question, and this question about any trade-off between transparency and liquidity. So, indeed, the what we advocate usually is this, post-trade transparency, at least, that in a way would not hamper, in my view at least, the ability to trade, because it wouldn't be pre-trade transparency. But can we still have situations where this post-trade transparency could lead to even more illiquidity?
If I could start, what I've heard about pre-trade transparency and how it can possibly undermine market liquidity is, if you have pre-trade transparency, everybody knows what the different dealers are quoting. It's possible perhaps to guess or infer which dealer has won the trade and then potentially trade against them before they've managed to offload that trade to somebody else. I think that's less of a risk with post-trade transparency, but maybe if it was like very close to real time and you could see a particular dealer building up particular positions, that could still be a risk.
Thanks, Nick. I mean, that's pretty much how I would have thought about it as well. And actually, as a matter of fact, I think regulators, when they introduced post-trade transparency, especially on core markets, they make sure that there is a sufficient, delay between the disclosure of the trade and the trade itself to avoid exactly that, so being front run, which I would completely understand. Yeah.
Could I take a slightly different perspective? Corporate debate about this in corporate bonds was vicious in the United States. Both sides were adamant, but the research shows that if you cap the transaction size in the reports that are released, the corporate bond market does significantly better on average in terms of liquidity by releasing the information immediately. There are costs, of course, on the front running side, but there are also a lot of benefits of people knowing what the best going price is, so that when they get a quote, they know whether to take it or not. So I would say cap the trade sizes, but don't delay them.
Oh, interesting. Yeah, I didn't know about this capping of trade size, but that's interesting. So you don't know that it's a large trade, but you know the terms of the trade anyway, pricing wise. Yeah. Great. So I think that we've come now to the end of the webinar. So let me thank all the panelists for excellent introductions, answers, and discussions. And also let me thank Ernest personally, and the SUERF network, and Bocconi for the organization of this initiative. And of course, thanks to the audience who has followed us throughout the webinar and with your questions and answers. And I wish all of you a very nice end of the day. Bye-bye.
Thanks, Imène. Thanks,
Bye.
everyone.
Bye.
Roasting. Right.